I think we are live. Good morning, everyone. Thank you so much for tuning in on a Saturday morning. And thanks a lot to Smallcase for this opportunity to be here and do this webinar for all of you. I'll also quickly validate if we are live. I think yes, I can see we are live right now. Just give me a second. Right. So, okay. So I hope you can see my screen. We'll get started in 30 seconds. And the main theme right today would be lower risk doesn't not always mean lower returns. And I'll try to emphasize on it, and we'll take it forward. We'll also cover two of our strategies today in details, and would also cover the overall multi-factor investing framework. Yes, we are live. Right. And 52 people are watching already. So I'll quickly start with disclaimers and some disclosures. And of course, a small introduction about me before we, go deep in. So I represent Goalfi. I am the founder CEO of Goalfi, and Goalfi, as part of the Gozen Capital Services Private Limited, is a SEBI registered research analyst firm. It's a corporate entity. We are on a small case from the month of October. We launched our small cases on Dhanteras Day, and we are finishing 6 months in next couple of days. So the disclaimers are that all of the work we will discuss today in terms of the research framework, in terms of the methodology, uh, is of course educational purposes. And a lot of inference will take from the already established index, which are live on niftyindices.com, and therefore do not constitute this as any form of investment advice. And I have actually put the same screen print of the disclosures which are on the smallcase app, so that the way the returns are calculated, the methodology behind it is available for you to kind of review later as well. A little bit about me. Um, I have been working in the industry for nearly now 16 years. Started my career in 2008, in the markets from 2011, broadly from 2015. Have double masters in computer science, in quant finance, risk management. Um, kind of trying to build a quant-based team. It's a very small team based out of Hyderabad, and our entire academic research is and is continuing with our mentors in the academia in the areas of multi-factor research. So that's about me. And of course, this is again the same screen print which you also see on the small case app. Right. So what is multi-factor investing? The topic is building a stronger portfolio. And I can see that 82 people are watching, so that's great. I think a very common example everybody takes is think about a cricket match, and think about a situation where we are in a super over, and then you only have to select one bowler and say two batsmen to kind of defend your team. If you think about the key factor, everybody would say that the best player would outperform, the best player would get to win that match, because the player you select in terms of the bowler or the batsman needs to be the Virat Kohlis of the world. But if you think more broadly, will the selection should be just based on that single factor, that who is the best bowler in my team and who is the best batsman, or it would depend on what kind of pitch we are playing in, what kind of opposition we are kind of tackling with, and accordingly decide which players should go into the playing into super overs, because that super over will decide the fate of the match. Something similar happens in the world of multi-factor investing, where you do not really consider size as the only factor, which can outperform or generate alpha for you. And size here, I simply mean that if you think about any broad market index, say Nifty 50, Nifty 500, right? How it works is the larger the market cap of the company, the higher the weightage of that company in the index. So Nifty 50 would simply mean the top 50 companies of India in the order of market cap. Can they outperform all the time? Can they generate alpha for you over consistent long period? because they are the big players, they are the big guys, right, out there in terms of, I mean, I want to name companies here, but the top companies in India in terms of market cap. And if you think, one step further, where we talk about diversification, that point get challenged, because when you invest money in broad market based index funds such as Nifty 50, you think you are highly diversified, but at the same time, your exposure to IT, your exposure to financial services would be the highest of the composition. The reason being, these index are purely driven by the market cap. When it comes to multi-factor investing, uh, these signs of passive investment, which is index investing, holds true here. Whereas you define some rules where size is not the only factor, where you could choose multiple factors. And I'll go deep. The next 40 minutes here will be talking about these factors which can really influence or generate alpha for you, and that has been kind of academically statistically proven in the past. So you still go with passive form of management of money, however have a layer of active added to it, so when to kind of rebalance, which factor should perform in which cycle of the market. Uh, and therefore, the multi-factor design index, if you think about it, is some combination of active management as well as a rule-based portfolio design, which we'll cover today. I'm seeing there because my screen is here. And in case, and I might see here because I see, some live questions. See, the communication mode of this webinar would be English. However, if you ask a question in Hindi, I'm allowed to, of course, speak in Hindi for to answer the question, because the audio is very broad, and we would like to use a language which can, where the message can be passed to a wider audience. So if you ask a question in Hindi, I'll absolutely answer in Hindi at the end, but the content would be covered in English. Now, a lot of work, if you see, which you see on the slide, done from the times of 1975 to 1992. If you look at these people, right, the pharma, French, the famous three-factor model. Then, if you see on the right, another work happened later where two more factors were added, right? Earlier, the factors were value, size. Now, the profitability, price to book, more factors were added to the asset pricing model. Started with, Stephen Ross, who did a great work in arbitrage pricing theory. So a lot of academic research over so many years, and new models have been evolving. And we also take a lot of pride in saying that we are continuing this academic research with our mentors, which are part of prestigious institutions like IIT Kanpur, in continuing this side of work. Now, talk about, before we go into today's, I mean, because today we'll talk about two small cases as such. We'll focus on two factors today, which is alpha and volatility. But so that you have the right context, a multi-factor portfolio, which is which will now see that how effective it would be. Usually, in the world of markets, these four factors have outperformed in the right combination when you use them, and basically tend to counter the cyclicality nature of broad markets, and where these four factors when put together can really add a lot of value. The factors here are alpha, which is basically a statistical measure, which is, if you can Google Jensen's alpha, you'll find how alpha is calculated. And I also have covered in this webinar later. Quality, there are different definitions of what quality, what do you mean exactly when you say quality company. But if you look very broadly in terms of return to equity, debt equity ratio, that how much is the leverage, and how much your EPS is growing in terms of year on year, you can determine what kind of quality that company can offer in terms of the balance sheet. Then when you look at value, that you talk about companies to be at the right valuation. If they are at high valuation, they need to have a balance of high growth. Otherwise, the valuation may not be justified. So you look at dividend yield, you look at price to earning multiples, you look at price to book multiples, right, etc. And you look at how much is the return on the capital employed, for example. And volatility as such would mean that how much is the risk taken for each unit of return you kind of try to generate from the market, right? Which is basically, if you think about mathematically standard deviation from the price. So what we'll do today, this kind of slide and the diagram is taken from NSE indices. The reason I am very careful about not really showing a lot of numbers, because of a lot of guidance from SEBI in terms of that I do not really would not want any sort of any sort of kind of view that I'm trying to put some numbers so that the small case percentage, what you see of our Goalfi small cases, is a promotion, and therefore the numbers, the kind of data used here is coming from NSE indices, which is our which is basically National Stock Exchange indices, and this data is available publicly to you, and which you can download and compute. Now, as I said right in the beginning, the main theme for the next 30 minutes is, do you really need to have a very high degree of risk to achieve higher returns? Is high risk is equal to high returns, or can you reduce your level of risk and still attain higher returns? Now, if you think about equity exposure as such, of course, when kind of people graduate from fixed deposits to say passive managed mutual funds to then equity exposure, it is a usual thought that we are now ready to take higher risks because we are trying to generate that alpha, right? The additional couple of percent alpha, and then that is called direct equity investment, because you are trying to generate that alpha for you, and you are assuming that a higher risk would help you achieve that. The way people assume that if they simply buy an index fund, which is a broad market index fund, where size is the only factor, which is like Nifty 50 index fund, they are reducing their risk. However, if you look at this diagram, which I'll explain, and again we'll refer to it in the end. If you look at this diagram, I have taken Nifty couple of multi-factor strategies here, which are computed by the exchange. And if you look at the first three dots, the top one is a 4-factor strategy where alpha, quality, value, and volatility are used. The second one is the 3-factor strategy, which is alpha, quality, and volatility. And the last two, you would know that Nifty 50 is the last one, which is the broad market. Nifty 200 I took because it's Nifty 50 sometimes is very concentrated. Nifty 200 gives you exposure to large caps, to mid caps, right? So that kind of exposure you can see from Nifty 200. Now, very interestingly, right? If you see the interesting numbers here, this is all of these indices are benchmarked on 1st April 2005, which means the numbers we are right now talking here is from 2005 to 2023 March. Nearly 20 years of data, right? If you think about it, 19 years of data. The net return, right, of Nifty 50 is nearly 13% CAGR over all of these period, 20-year period, 19-year period. Nearly the same with Nifty 200. But see the volatility you have to go through in this period. There is a volatility of around 22% to achieve 13% of return when investing in a broad market-based index fund. Now, if you see a very interesting, quadrant here, you basically are you're beating the benchmark. You're beating your base benchmark, which is your broad market benchmark, by a huge margin. You basically are making around returns are 17, 18, 19% kind of number. You are beating the benchmark by 4%. And look at the volatility, right? You are on the one bar left. You have a volatility of around 16%. So less risk you took, more returns you made. And that was the whole kind of title where I was trying to highlight that if you look at 20 years of this data and you look at how these 4-factor strategy, 3-factor strategy, 2-factor strategy can outperform the broad market by a big margin. Now, how do you relate this to small case or Goalfi small cases? Our alpha blend is a 2-factor strategy, which is alpha low volatility. Our balance basket is a 3-factor strategy, which is alpha quality low volatility. And our recent launch multi-factor, which we launched on 1st of April, is a 4-factor strategy, which is Nifty quality value low volatility, right? So the numbers you see here now another very interesting chart. The reason I took Nifty indices chart is again to kind of make sure that it is not against any regulatory guidelines, and this data is published on the index website, and it's just simply a download from there, and you can plot a chart in Excel. Since, as I said, it is based on index of 1000 at 2005, April 2005. It is indexed at 1000 value. All of these 5 index, broad market, Nifty 50, Nifty 200, and the 2-factor, 3-factor, 4-factor. You see the kind of returns it has made over the last 20 years. And the percentage which I have just told you, and again explain the next slide. So 1000 became nearly, I'll see 10,000, right? From a Nifty perspective. So your money is 10x in the last 20 years, which means a return of 13%. But if you look at, other strategy like Nifty alpha low volatility, which is, I mean, you cannot do apple to, I mean, you can't do direct comparison, but our base is alpha blend is alpha low volatility. You see, in the last 20 years, 1000 has become nearly 26,000, 2.5, kind of 25x of your money, which is nearly 17% CAGR, right? That extra 4% CAGR, which you can obtain by being active plus passive together using quant methods, you can really, create double of that. So where one became 1000 became 10,000, this 1000 became 20,000. So instead of 10x, right, you achieve 20x over the same period. Your 1 lakh, instead of becoming 10 lakh, became 20 lakh. This representation is easily explained here in this in this slide, where what we are trying to kind of show here or emphasize here, that multi-factor index strategies deliver long-term risk premium over traditional market cap-based index, which means if you look at the first 2 columns, Nifty 50 and Nifty 200, as I said, since inception, Nifty has given 13% return, CAGR. Nifty 200 also given something similar return. And this data is from April 2005 till March 2024. Right, so that you have April to March, and then this years are completed, and we are in 27 more days in March, in April, so just 27 days old data. Now, if you look at the 10-year return, 7-year returns, 5-year returns, or even 3 months, even though 3 months have no meaning, I mean, really, you should not benchmark anything against 3 months. Minimum is 1 year from a benchmarking perspective. But even if you look at from a 3 months perspective, Nifty is around 2.5%, Nifty 200 is around 4%, and then your 2-factor strategy, your 3-factor and 4-factor is outperforming the benchmark by a big margin. Let's look at last 1 year. And here 1 year is not 2023 calendar year. Here 1 year is October to, July to, how do I say, March? Rather April to March, right? Yeah. And think about it from a 6 months perspective, because we launched our Goalfi small cases 6 months ago. So I can then use, say, 6 months as a starting base. So in 6 months, where from October, November, December to March, October to March, Nifty is nearly sitting at 14 odd percent. Nifty 200 is sitting around 17 odd percent. And if you look at Nifty alpha low volatility 32, Nifty alpha quality low volatility, which is 3-factor, is 29, and if you look at 4-factor is 29. Now, I would not want to compare, and of course the comparison should not be made because the methods are different. We have our own proprietary methods, but I see from my perspective, or our team mandate perspective, that are we doing good in terms of generating alpha for users by doing quant-based academic research. And if you look at it, if my alpha blend had to this, if my balance basket had to this, and if multi-factor had to be here, right? And I am very happy to see that once we go down, and of course, the numbers you can check yourself on the small case app, but we are able to do justice to following a passive plus active index-based strategy. So look at the last 6 months. I think we are doing fairly all right. And these are not our numbers. These are not our indices. These are indices constructed by Nifty indices.com, which is NSC's part of the organization, who help create a lot of index so that it becomes inspiration for the fund managers and influence for the fund managers to create ETFs, to create index fund out of these strategies. So last 1 year, where Nifty 50 had been superb, the alpha strategy, alpha volatility strategy, I mean. So, and just to kind of reiterate, we are not a single factor strategy. We use multi-factor strategies across all our 6 small cases. Now moving next, I'll kind of try to spend 5-7 minutes here because this is very, very important. Now, what it is trying to highlight, multi-factor index strategies tend to counter the cyclical behavior of single factor index. Now, what happens, right? So your Nifty 50, as I mentioned at the start, is heavily relying on financial services, IT, automobile because of the weightage, because of the big companies like Tata, I mean TCS, Infosys, HDFC of the world. And therefore, it is natural that when you invest money in Nifty 50, a large amount of your money goes in that company via the index fund. Or even if you're taking on large cap managed mutual fund, uh, of course, there is no alternative but to spread the money in some kind of similar proposition because you need to have a benchmark, which is a broad market. Now, if you look at how the use of multi-factors, which is academically proven, which is statistically proven in the Western world, and of course, a lot of it is now picking up in India, where few mutual funds are started to create index funds on these, and there's a I mean, I've been when I started speaking on YouTube in 2018, I spoke about Nifty indices and very, very happy and proud now in 2024 that after 5 years of kind of talking about it, and finally we're able to kind of implement in the best form we could. So if you look at it, right, I mean, and few years are very, very kind of prominent in your mind, which could be 2008, right, which could be then the 2009 recovery. And if you start with 2008, right, when the actual crisis happened, when was the start of my career. If you look at Nifty had a good 50% plus fall, Nifty 100, which is, the next 50 companies together also had a 50% kind of correction. Now, if you look at these strategies, right, your three-factor strategy, Nifty, Alpha, Quality, Low Volatility, had a least of the fall, 43%. Even your four-factor had at least less than Nifty 50. But look at the recovery. When recovery happened in 2009, of course, your Nifty gave, 75% return. But look at the number here. Look at four-factor strategy. It gave 91% return just the next year. And if you look at from a, it's not a one-off. So the point being, different factors. So when you work on a single factor strategy like alpha as a factor, quality as a factor, volatility as a factor, each factor will work in different market cycles. For example, your broad markets where they're outperforming, I will be happy to see if they're outperforming anywhere. Even if 2011 there was a fall of 24%, your multi-factor strategies hardly had 13, 11, and 14% fall, which is a great number. And if you look at the recovery or the last year market, right? Last year market, 20% Nifty, and this is actual calendar year, Jan to December, versus in the earlier slide, I was actually showing the last 6 months or the last 1 year, which means from March to 1 year, which means the calendar year in the previous slide. Here it is actual, the fiscal year in the last slide. Here it is actual calendar year. So 2023 returns, where the Nifty gave 20%. You see how beautiful the multi-factor strategies has outperformed the market by a big margin. So I'm just trying to see if Nifty did well in any of the years, and I'm sure it would do, right? It would do, because what happens when there is a period of when digitization happened, when financial inclusion started to happen, of course a lot of money, a lot of easier credit was available to NBFCs and the companies in that sector, and therefore that liquidity help the companies of the broad market to get more capital and expand their business. But if you look at from and I'm struggling to find those numbers here though, but there would be periods when your broad market may have a slight period of outperformance in a very small period. But if you look at any rolling return, any 3-year rolling return, any 5-year rolling returns, then I'm struggling to find any event where the multi-factor strategies didn't work or didn't outperform the broad market strategies. And unfortunately, as of today, also, the only option we have is index funds. And when we say index funds, we do not have a four-factor strategy index fund. NSE has the strategy, has the indice, which you can search yourself, but nobody has yet created an index fund out of it. And therefore, if you look at the small cases, they're a beautiful instrument because we are able to do our research in that area and able to create those strategies. Now, a couple of highlights. So this was a slide where it will kind of show from 2005 to 2024 what kind of returns your broad markets, Nifty 100, Nifty 200, and how the 2-factor, 3-factor, and 4-factor strategies have given. Okay. Now, another very, very important slide where the whole idea was, if you go here, I made 91% in 2009, say, I mean, somebody would say I was following this strategy. Is it worth the risk? Is it worth the risk of kind of not following the index, but rather trying to follow a statistically proven index? Is it more risk or less risk? Again, coming to the same original point. Now, this is again, so powerful slide. And if you look at from inception, right? I don't want to talk about 6 months, 1 year, 2 years here. If you think from a perspective of inception, if you look at ratio of return to risk, right, which is your ratio of standard deviation. If the price moved from 100 to 120, say, or say 110 at the end of the year, 10% move, but then it went to 90, it went to 120, right? There was a period of volatility. Every month the price would have changed from 100 to 102 to 104 to 98, right? And then you compute the monthly percentage, then you compute the standard deviation in terms of how far the volatility here, and then analyze it. You find the standard deviation, you find the ratio of return to risk. And if the ratio of return to risk is higher, it means for each unit of risk I took to make that 1%, how much risk I took. And unfortunately, in the broad market index, if you see, are sitting in the range of 0.61 from inception. But multi-factor strategies, if you look at these three, they are sitting from 0.9 to 1.06, which means for each unit of risk I took, I have higher returns in a multi-factor strategy. So this is so powerful. And even if you look at the last 1 year, right here, of course, Nifty had made a lot of move, and therefore you see, a higher risk ratio of ratio of return to risk. But if you look at, alpha low volatility, which is 2-factor strategy, which combines alpha and volatility, and that is why, because alpha and volatility as a combination is one of the, I would say, best workout, and therefore alpha blend kind of try to make it as a base, and we do alpha blend kind of keeping that strategy in mind. You see, of course, it didn't make 91, but of course, it couldn't beat the benchmark in that year in phase of recovery, because this is how alpha works as such, because you have added volatility to it, right? So because when you added volatility to it, when the markets are falling, it is falling less. So in different market cycles, for different risk appetite or different users, for different rebalance preference, all strategies could work in some form or the other. But our focus, as I said, is today on alpha blend and balance basket, which would be 2-factor and 3-factor. And see, look at this, right? This is, I know, a very, very kind of compact slide, but a very powerful slide. Again, going to the original point, and I think I have again 15 more minutes in this session, and of course I'll take all of your questions. The good thing here is, and of course the legends are missing, because slides were, I was making it last night, and the slide was it was difficult to get all data here. The idea is trying to show, which I started in the beginning, is a lot of your money is getting invested in financial services and IT at all time whenever you are putting money in your broad market index fund. But multi-factor investment strategies takes, and they will be cycle. There will be cycle of chemical, there will be cycle of pharma, there will be cycle of automobile, there will be cycle of financial services. That gets missed out in a broad market, because that is only using size as a factor. When you use these alpha, volatility, value, quality as a factor, you will see that where Nifty 50 has, say, this kind of weightage of say one color is one sector here, you see that if Nifty has the financial services as the 22% weightage, if you see in low volatility today, this is latest data as of March 2024, only 13% is for financial services, and highest is some other sector. Similarly, if you see, so what happens in a multi-factor strategy, it kind of counter your cyclical nature of these sectors. And when you are in a multi-factor strategy, a 4-factor strategy, it will have a very sweet combination of sector diversification. So when I go now next in our small cases, you will find that even though our small cases are very, very concentrated, where we are 7 or 9, they are very well diversified, which I'll show now in the next slide. All right. I'll take questions at the last. I see that uh, there are 60 people who are watching right now and a lot of questions also here. But let's take another 10 minutes before I go into questions. And the reason, I wanted to keep the numbers as hidden because that's where the new disclosures are. And that's what the new guidance are from SEBI. And I mean, the guidance are kind of not matured in yet. And of course, we as a RA community are also trying to see what is best from a perspective of see the whole idea, the whole intent of regulator here is to safeguard retail investor interest. And we, all your small case managers, I am sure, are working hard to make sure that you are not misguided, and therefore the initiative of or the guidance of not showing the numbers for the same reason I am not showing how much alpha blend and balance basket I made in the last 6 months, because you can very well go there and check yourself. The numbers I have shown prior are public numbers, are calculated by the exchange and not by me or small case, and therefore I could freely show you how much 3 months, 6 months, right, the numbers are. These are of course the methodology to calculate this return is of course published on the platform, and you can yourself go and help and check yourself, because small case also base at 100. But the whole idea is once you go, you have to agree to these disclosures so that the numbers can be seen by you. Now, two strategies we are totally covering on. One is alpha blend market leaders, and one is balance basket, and I'll give a very quick brief for multifactor, which is the latest launch. Now, if you look at alpha blend, I see a lot of confusion in a couple of people who are reviewing our small case that we are we are small case and we are small small cap. We are small case heavy. We are not small case heavy. If you look at our current composition, we are 20% large cap, 30% mid cap, and 50% small cap. Now, this is the advantage of using a, and this is a two-factor strategy. If you look at here, we talk about, we basically find concentrated group of high alpha stocks, and then we combine volatility here, right? If you can see my mouse moving somewhere, right. And this is rebalance on a weekly, now bi-weekly, because when market are in momentum, we of course do a lot of our model tests to see what is working out, and we see bi-weekly being the sweet spot in terms of finding alpha opportunities, mining with volatility. And of course, it's a very dynamic strategy, and therefore when needed, it could move the money into safer assets. So it's not small cap strategy, and we are any market cap agnostic, because size is not the factor. We have alpha and volatility is a factor, agnostic of the size. Of course, we take care of the liquidity part. We take care that we do not invest in micro caps. Because we invest in Nifty 750 universe, right? I mean, we kind of research in Nifty 750, which means companies which are above 3,000 crore market cap are usually our universe. And we make sure that the average volumes are more than a lakh, so that you never have an issue of kind of partial rebalance or struggling to kind of find your bits, right? So something which is useful for you to see. Of course, this is the latest kind of computation of the financials. Again, how this are calculated is already being written on the website. The price to earning multiples, the price to book multiples, the dividend yield. And if you look at the thing I want to focus here is on the sector composition. You see, even though we are concentrated 7 stocks, they are from different sectors, right? That is the power of having a multi-factor or a two-factor. And when I say multi-factor, do not take at 2 or 3 or 4 different strategies. Different factors work best when combined with 2 together, 3 together, 4 together, and different strategies based on different rebalance preference. For example, our 3-factor strategies are monthly rebalance, right? Balance basket. Our 2-factor strategies are weekly rebalance. Our 4-factor strategy are need basis rebalance. That's how we have differentiated, right? So if you look how well the alpha blend is kind of distributed into different sectors as of now. Some technical kind of jargon here in terms of what exactly is alpha, how do you compute alpha, right? So and how do you compute volatility? So the first section talks about how do you compute alpha. where you kind of take into account the risk-free rate, you take into account the beta, and then you kind of compute using Jensen's alpha formula. And then what do you mean by volatility, which is basically inverse of the standard deviation, right? Is the volatility. And then you basically do a average factor level Z score to find the so that you can combine with different weights the stock alpha and stock volatility to make a final alpha volatility score. And basis that, you can construct a portfolio. So that's on alpha, blend for you. That's a two-factor strategy, alpha and volatility. And if you are not quickly remembering, this is what alpha and volatility was in terms of how much risk you take, right, for generating the 1 unit of return, which is a positive number above one, which is since inception and goes very high in the good markets, right, in a bull market. So which is a great sign here, and which is a two-factor strategy. Now, if you go to balance basket. Now, balance basket is a three-factor strategy where you combine, and I kind of emphasize that all our strategies would have alpha because the whole idea is to generate alpha, right? Here, the another layer we add is quality to the balance to kind of have balance because it is monthly rebalance, and the whole idea is that, and if you see the market cap distribution, it is 35% large cap, 10% mid cap, and 55% small cap as of today, as of now. And this basically combines your three factors. If you look at this slide here, also, as I said, again, very less number of stocks, very well diversified. You see, this pie chart fully populated, and you also see the multiples of the balance basket here, which is the price to earning multiples, price to book multiples, which are uh, uh, which is, I think, going well, right? In terms of price multiple, in terms of price to book, if you see 18 versus the base index, which it is trying to compare to based on the system configuration, right? In terms of highest weightage. However, if you know now, because you know now, right? We compare this with a three-factor strategy, right? Which is alpha, quality, low volatility. That is our internal benchmarking. Right. So go to into balance basket again. Balance basket, now quality has a lot of meaning, right? From Graham to Warren Buffett to I mean, as moving on, different people have given different definitions of how do you call a quality. See, there is no challenge anywhere in terms of what is a momentum. All of the academic world understand momentum is high buy or sell. I mean, you buy at high and then you sell further high, right, in terms of rising momentum. Value is also not a debatable topic. People understand that valuations are measured by price to earning multiples, price to book multiples, etc., etc. Quality is the only factor which is not yet kind of concluded in terms of what exactly is a quality, right? For the purpose of work in terms of delivering the output, three things we mainly take into quality as a parameter. One is profitability, which means what is the likeliness of success of the company. If the company is profitable, we also are a new startup, right? Launched 6 months ago, trying to be profitable from day one from a unit economics perspective. How much leverage, financial leverage the company has taken, which is kind of tell that what is the self-reliance, how much, I mean, except the NBFCs or the companies where the leverage is the key thing. But other than that, how much is the leverage so that you don't go bust? And what is the earnings growth? And is there is a variability in the earnings growth? Are you growing quarter to quarter, year to year? Which means consistency. Are you able to when you publish your quarterly results, are you showing a consistent growth of earnings, right? So that's the quality parameter. So when you combine alpha, quality, and low volatility, that's become a balanced basket. Now, also, there will be, I think, for all our viewers here, there will be a coupon code for alpha and balance baskets today, which will be shared, I'm sure, shortly by the small case team. It will be available on the app and the microsite. So details will be shared, I'm sure, in the YouTube live shortly. Now, multi-factor is a four-factor strategy. I'll quickly, because the focus was alpha and balance basket, and the coupon is also available for that. And the coupon is here, which you see on the YouTube live. Multi-factor is a four-factor strategy where it's a I mean, in a product where it is a need basis product, a larger ticket size to justify the fees, if you think that way. And we had a lot of users who had put tangible amount right in our existing baskets, where they kind of demanded for a product which is need basis. And we anyhow wanted to launch a four-factor strategy, and this is what multi-factor is. Uh, Multi-factor, if you see, has also the numbers out. Multi-factor also has nearly 9 composition, very well diversified. Uh, and then if you look at the multiples, the price to earning multiples of multi-factor strategy, the price to book, they are looking in control and good. And this is what how you compute quality, return on equity, debt to equity, EPS growth, value, price to earning, price to book, return on capital employed, dividend yield, alpha, which is on the CAPM model, capital asset pricing model, and then volatility, which is standard deviation of inverse of it. Then how do you kind of, this is again coming from NSE indices, right? That's the inference taken from there. A lot of good work done in the academic area, from as I said, Pharma French to Eco Jacobs, and a lot of these kind of research paper. We have been kind of continuously doing a lot of research on this subject. We want to democratize access to multi-factor investment research, and the route we have kind of started to take is uh, I subscribed while you were just taking before you gave the code. So I was reading the chat. Mr. Ghosh, don't worry, we'll manage it in the next time. So that's what about it. I mean, from a presentation perspective, uh, I hope it was kind of valuable, and I'll answer all of the questions here. We can be contacted on WhatsApp using chat.goalfi.app. It's a WhatsApp number which you can chat. Usually it is working from 7 a.m. to 11 p.m. My entire team can access. You can also book a meeting with our team, which is meet.goalfi.app, which is a calendar booking. It shows the open slots of our team, and you can book anytime, any day. You can also go to Goalfi.app. It will redirect to the microsite, which is small cases, right? So that's about it. I will now kind of go and answer all the questions, right? So Varun is also here with me, part of the team, and I'll go one by one. Uh, so just give me 1 second. I'll rather stop sharing, because that will, I think, and bring this screen here so that I can see on the camera and talk out, right? So Amit says, good morning. Good morning, Amit ji. Ravi, hi. Amit Kumar, how does the team size impact the research in stocks? Team will eventually grow, right? I think it's always good to start small. It is always good to follow the principles you otherwise kind of try to explain, where profitability is important, where EPS growth is important, quarter on quarter, and therefore small team size will eventually become big team size as we progress. I don't think it impact the research, because ultimately, if you think about it, I am the research analyst here from a SEBI RA perspective, and I've been doing the work on this quant-based, factor-based investment research from some time, and that learnings of mine I am trying to incorporate in small cases. Subha Jyoti Ghosh saying, what is the AUM for your firm across all strategies, if that can be disclosed? Not sure if that can be disclosed, but I mean, small case team will permit it, then I would. And I've been talking about it in my YouTube videos, because I also run a YouTube channel where I speak about it. And I think it's not, I think I have written on LinkedIn, so I think I am allowed to speak. I mean, last time I checked, we have gone till around 29 crores of AUM. In terms of 29 crore worth of money was invested by you in our small cases, and then a lot of sell-off happened during the correction phase. Right now must be sitting around 23, 24 CR active, and I think a user base of maybe 1500 users. Amit Kumar is saying, please use a mix of English and Hindi. I think I answered that in the beginning. Does multi-factor mechanism able to identify multi-baggers, unlike some other small case rationale who identify untapped good stock and hold for longer time frame? The strategy as such, right? So if you look about the strategy from a rebalance perspective, it's a very, very, it's a notion that And I'm not totally against buying and holding for a lifetime. You may do it. But if you look at index strategy, if you look at quant-based strategies, and I've given examples of actual Nifty indices strategy, there is a rebalance every quarter, every 6 months. So when there's a rebalance every quarter, every 6 months, and when the intent is also to book profits, right? Uh, you remaining invested in a stock which will become multi-bagger may not come out, because the whole idea, right? If you compare, I will rather also use the same slide again one more time to emphasize that how much this extra 3-4% can make made a lot of difference, right? In terms of your multiplying money. And that's what I tell my users who come and say, I want to, I mean, in how many years my money will get doubled. And then the simple answer is, if you look at this, right? If you look at this slide, let me know if you can see it, right? So uh, rule of 72, if you think about it, if you put money in a bank, 7.2 rate of interest, then it takes 10 years to double your money, right? There was a time when you can double your money in bank in 5 years, but then the inflation was the same level. Now with the current inflation rate and the current fixed deposit, that too on the higher side, you can double your money in 10 years. Whereas when you now invest in index funds, which are Nifty 50 index fund, Nifty Bs, any of the product which is broad market, it is 13. So you can think about it like 6 years, kind of 5.5 years. There you see, when you do 18% in a two-factor strategy, and again, this is not my number, this number is, as I said, is index number. This 18% is doubling money every 4 years. And if you intend to double your money every 4 years, this is the way to go. What would you do with multi-baggers when you are not able to consistently make money? And 8 is a beautiful spot, right? When you try to do in 3 years and try to get 24%, you would not get. Nobody has got, right? Ever, unless you are Jim Simons of the world and have your Medallion Fund, right? That that kind of science running it for you. The power of mathematics and quant with what Jim Simons does. But if you think from a very holistic perspective, and you think about from a 13 to 18 right journey, you think about this chart here. The same 13 to 18 journey can take your 1,000 to 10,000 versus 25,000. Think about it from a impact it can create for you. So where you can make this 3-4 extra% is the whole idea. Here we do active management, and when you do active management, the churning is a part of the game, and therefore rebalances happen, and therefore rebalance will happen, and therefore multi-baggers you may find, but ultimately you will book profits, at least in our strategies. Loveleen Arya saying hello. Hi, Nidhi saying interesting. So thank you, Nidhi. Thank you, Loveleen. Being a concentrated portfolio, how does it protect from downside? Would it also hold good during a downfall? I answered that question, and I have also kind of shown that downside protection here. If you see return ratio of return to standard deviation, and I have kind of statistically proven here that all of these strategies, when they are multi-factor, from a long period perspective, for the unit of risk to you take, you have a added advantage of lower volatility versus your broad index. And yes, the it would move into safer assets when required to hedge into gold Bs, liquid Bs, etc. Devendra is saying very insightful session, Robin. Thank you, Devendra. Lovely in saying very nice explain. Thank you. Ankush Srivastav is saying, what is the minimum investment in a year for getting meaningful return in multi-factor? See, as simple as that. If you are not able to get to a 1% expense ratio, right, then the charges it would incur, transaction cost, the small case fees, it is not worth it. And therefore, if you see the fees as relevant to the minimum amount, if the amount is 7.5 lakh, we have kept fees as 999, which say maybe a discount running at, I don't know, 7,999, which would mean 1%. So unless you're investing that capital, right, in a multi-factor strategy, which is say nearly 10 lakh, 7.5 lakh, then there is no value add, right? You're not doing justice to the money you have paid for fees. Why don't you compare your small case to Nifty Alpha low volatility? We do compare. See, it's not about comparison here, Mr. Ravi. If you look at the two-factor strategy, and if you look at the two-factor strategy returns over the last 6 months, two-factor strategy is our alpha blend strategy in our mind, in our thoughts, in our framework. And two-factor strategy alpha blend had been doing good from perspective of the index. And I'm very happy to kind of say that the numbers you can find out yourself, but we are able to kind of beat that index by a margin, right? So that's what the value we are trying to add to our users. So we have compared our alpha blend with 2-factor, our balance basket with 3-factor, and our multi-factor with 4-factor. When you add value to low volatility in alpha, those value picks should return higher returns. What are they giving? Lower return instead. See, value unlocking takes time. So if you look at this, right, if I give you this is a very interesting point. And if you look at Mr. Ghosh, right, if you look at 2000 and 9, right, 2009, right, when recovery happens, right, and if you look at single factor strategy, right, broadly, you will see that alpha volatility strategy has underperformed, right, in 2009. That's what I was trying to tell even that time. If you look at the broad market when making 75%, unless you added the value parameter to it, right? If you see 91, why 91 has come here? Why 91 has come here, right? It was 59, it was 73, it is 91 because of the extra parameter value. Now, when you say lower returns in which year you have to explain to me. But see, when markets are in very high momentum, companies are not available at low valuation. A high valuation will only be supported by high growth rate. That combination to find that you are sitting on a high price earning multiple, and then your growth rate is so high that that price earning multiple is justified. Then only the value companies can create value. Otherwise, it create values when there is an economic recovery. Usually, in if you do research, when economic recovery happens, then value portfolios really outperform. Would alpha momentum always outperform multi-factor over duration? Okay, so that's the answer for you. Will multi-factor always outperform? I mean, from the data we have from 20 years from the index, it is, but there is a catch, right? Are you comfortable in your alpha strategy, for example, to have much lesser returns, like in 2009, when your multi-factor could make kind of bigger amount of returns, for example, right? So if you were in alpha, overall, yes, I can understand what your point. I mean, there is a 1% buffer, when extra kind of advantage there, but there are periods when your 2-factor strategy will perform less than a 4-factor strategy. Usually when markets recover, right, in terms from a recovery after a correction, then 4-factor strategy usually outperform. So here, right, the simple way to select is you can go ahead with 2-factor in terms of your rebalance strategy, weekly, monthly, and need basis. That's how it's separated out. मल्टी फैक्टर स्ट्रेटजी में सभी फैक्टर को सहमित किया गया है या उस समय की बाजार की परिस्थिति के आधार पर उस फैक्टर में ज्यादा इलेक्शन होगा, एलोकेशन होगा? जोशी जी पूछ रहे हैं कि सारे फैक्टर हैं या फैक्टर्स सारे हैं? अच्छा, हमारा एक और एडवांटेज है, मैं इफ आई टेक द लिबर्टी टू स्पीक इन हिंदी इन द लास्ट, we have 6 factors rather than 4 factors in terms of another layer, right? We have added 2 more layers. So if you see alpha, momentum, quality, value, volatility, and growth, we have 6 factor strategy in multi-factor in real sense. Because there is no 6-factor strategy available on the Nifty indices to show you the point without showing you numbers which are computed by me. So I was trying to show you multi-factor there, but yes, the allocation of the factor would depend on our own methods. There is no flat 20%, 25% weightage of each. It's the model which runs and of course decide how much allocation should happen to alpha or quality. What is important in that period? Is it quality? Is it value? Is it alpha? Alvin Racing, you're guiding us so well through this. Thank you, Lavleen. Where was everybody? I am a subscriber of Alpha Blend and Value Investing Small Case. If I have to choose or only one to which you consider, those are very different, Weber. Alpha Blend and Value are two different small case, two different philosophy, two different rebalance frequency, two different strategies. So you can of course book a meeting on meet.goalfi and we can of course chat. Pradeep is saying I've invested around 60K. After 3 months, return is 1K. Don't know what or how are you managing. Pradeep ji, 60,000. Okay, so you invested 60,000 and 3 months return is 1,000. And you are saying what you are managing. Don't know what or how you are managing. In means of relative percentage. See, think about, I don't know, Pradeep, if you have invested as a SIP form or invested as a lump sum first, but think very broadly in terms of trying to compute how much is the minimum investment you should have to see the tangible outcome to match the fees plus the transaction cost, and also give time, right? Give time of 6 months, 1 year, even 1 3 months for that matter. The point is remain invested, follow the rebalance frequency. Do not try to average it down. Do not try to add more money when do not try to take actions unless you are actually doing yourself. So didn't understand the question exactly, that your return is okay. You made 1,000 on 60. Okay, okay. That's a number, right? So that's a percentage. Understood. Very nice. Full thanks. Thank you. So he's my father here. Very nice. Okay. And how do you decide to remove a stock from the portfolio after it has given some good returns? How do we decide? So see, it's a method, right? I explained that you're computing the top alpha scores stocks. You're also computing the top volatility scores stocks. You're combining them and making them a well-diversified portfolio. You're making sure that the liquidity is enough. You're making sure that the sector allocation is catered to. Then the stocks which when they compete to get into the list, right, of the top seven, automatically the top one which has moved on have our guidance is over on that kind of have book profits, right? So there you can book profits there, Mr. Ghosh. And last 3 months, if you invest in Jan market was a peak and then went down and just going, okay. So Mr. Ghosh was answering Pradeep that because he invested 3 months ago, the returns are flat. Ravi Rajput is saying on a small case platform, your small case should be compared to alpha low momentum and not small cap index. So Ravi, this is a very new piece of area, right? In terms of multi-factor investing. I am very sure that a lot of AMCs, a lot of brokerage houses will start now contemplating on creating index funds. Right now, the broad index funds are market cap funds, market capitalization broad index, right? Nifty 50, Nifty 500, etc. So in the system, you can't compare, but you can compare yourself, right? Is the whole idea. Uh, the minimum investment amount and the fees has been kept slightly high for newly launched small cases. Please reconsider it. I again explained, Ashmi ji, I explained that the rationale of 1% nearly so that you have the right thought process, because if you pay a lower fee and invest a lower amount, the whole idea of giving it the due treatment in terms of need basis rebalance, in terms of doing the research on multi-factor, continued research in collaboration with a lot of academic partners, there is no value add there. And as I said, right, all our small cases are multi-factor. So don't think this new multi-factor wealth maximizer is the only multi-factor. Alpha is 2-factor, balance is 3-factor. So they are multi-factor in any case. And they have very, very small, investment amount and the fees. How many small cases need to take for better return for long term is if you manage multiple small cases. I think you need not take multiple small cases. I mean, Goalfi small cases. Of course, you can have your own way of asset allocation and your own investment advisor would guide better. But from perspective of Goalfi, I go about it that take it from a perspective of need. I mean, from a rebalance perspective, and we as a team believe in concentration, right? Because we are anyhow diversified from a sector perspective. So that is how there is no value add if you add 2 3 small case of Goalfi. You can just get started with what suits you best in terms of rebalanced strategy. I explained. Go ahead with it. Spend time with it 1 2 years, then decide to switch if you wish to. If someone has to invest big fund, say a couple of crores or half a crore, multi-factor enough to diversify 2 3 small case generate returns in 3 5 years. Please reply in Hindi. अमित जी, अगर आपके पास 1 करोड़ है, आप इन्वेस्ट करना चाहते हो, देखिए रिसर्च है ना, दिस इज अ रिसर्च एडवाइस. वी आर गिविंग यू रिसर्च एडवाइस यहाँ पे. अब आपको इसको कंज्यूम करना है या नहीं करना है वो आपको आपका आपका राइट है. एक अच्छा टेक टूल है, वन ऑफ द गुड इनोवेशन इन द वर्ल्ड ऑफ इक्विटी इन्वेस्टमेंट, स्मॉल केस, जहाँ पे आपको वो रिसर्च हमने एक पैकेज फॉर्म में दिया है. अब उसमें आप इन्वेस्ट कितना करते हो वो आपका चॉइस है. हाँ, अगर सवाल ये है कि क्या हमारे स्मॉल के क्या हमारे सिलेक्शन में लिक्विडिटी होगा कि वो आपका ये फंड मैनेज कर सकता है, एब्सोल्युटली लिक्विडिटी होगा. हम लोग ऐसे स्टॉक्स पिक नहीं करते, हमारी रिसर्च में ही नहीं है जहाँ पे लिक्विडिटी का इशू है, जहाँ पे दिन में ट्रेडिंग नहीं हो रहा है, बिड आस्क कम है, वॉल्यूम्स कम है. तो वी हैव अ फिल्टर, वी हैव अ फैक्टर वेयर वी मेक श्योर दैट अगर आप कोई लार्ज सम ऑफ मनी लगा रहा है हमारी रिसर्च सर्विस पर, हमारे उसको कंज्यूम कर रहा है, तो फॉर नाउ द अमाउंट यू मेंशन आई डोंट थिंक इज एन इशू फॉर मल्टी फैक्टर स्मॉल केस. उसमें ऑलरेडी 9 स्टॉक्स हैं, तो इतना मनी 9 स्टॉक्स के लिए तो एक छोटा अमाउंट, मतलब एक रेलेवेंट, मतलब एक ठीक अमाउंट है. Should small Goalfi small factor small case sufficient or one should go for combination of multi factor? नहीं, सैंपल यूजर नाम आ रहा है आपका, आई मीन सॉरी, क्वेश्चन इज इन इंग्लिश, योर नेम इज कमिंग सैंपल यूजर. आई डोंट थिंक you can, see, you are already able to generate good returns in terms of percentage, right? uh, I don't see any value in combining a 4 factor, 3 factor, 2 factor strategy. I don't think so you need to. If you want different rebalance, you can choose one alpha. I mean, again, not a recommendation here, but you can choose one weekly rebalance baskets, say like alpha blend. You can choose one monthly rebalance like balance basket. So you get a layer of quality there added if you wish to, but not a recommendation here, so that I make it very clear. Hello, sir. Did we have to do SIP in small case? Yes, and how this will impact? You can do SIP, Prabodh George Singh ji. Yes, of course, you can do SIP. The whole idea is I recommend that SIP should be in the multiple of the minimum investment amount, say Alpha Blend, 15,000, Balance Basket, 25,000, so that the spread across the allocation of money to your stocks is proportionate, because in India there is no fractional investing, so you need to buy the full stock, and therefore if you put a little higher good amount, 10, 15,000, you're able to buy in the right weightage. Investor is asking me some view. Investor name is investor. Some view on a company. I don't give openly any view on any public. I mean any public forum. My views on any company. सपोज मंडे को 7.5 लाख इन्वेस्ट करूँ मल्टी फैक्टर में, इससे राइट टाइम टू इन्वेस्ट. बाई चांस सर क्रैश आया, मार्केट डाउन गया मार्च की तरह, तो मल्टी फैक्टर में कितने पैसे डाउन आ सकता है? So see, I have been telling in my YouTube channel also that do not go full in right now. Invest 60% of the capital today. Keep 20% for post elections, the next half of the year, and 20% for any such opportunities when the markets are kind of giving a good kind of deep correction of 10-15%. So when you come talk about multi-factor, if you talk about alpha and balance, the minimum investment zone is very small, so you can get started right with 60%. Because when it is multi-factor, this newly launched small case, unless you are sitting or planning to invest 10, 11 lakhs in that small case alone over next 3, 4, 5 months, do not start with it, right? Because then you are going in full in, and then when the markets are giving you a kind of a correction, deep correction, or profit booking is happening post elections, for example, you should have capital at hand, right, to go again. Ghosh ji saying 2017. Somebody is asking a stock, will it recover? It's a lump sum, G. It's a lump sum. Okay, very nicely explained. Thank you. Small piece allocation is high. How much micro allocation is that? Prahlad, what is the rebalance frequency? Okay, I think we are now over the time limit. I did not even check my phone if I'm getting warnings that the time is due. But I think I've answered a lot of the I mean all of the questions here. Let me again quickly go back to YouTube. Nice presentation. Will there be another strategies which Goalfi looking to future? Not now. I think we are doing more and more work on the multi-factor investment research, and we'll continue to do it. Okay. So Prahlad Reddy is saying what is the rebalance frequency in multi-factor? It's a need basis, Prahlad ji. It's a need basis rebalance frequency. All right. I think it was very, very well good, use of my time. I hope I added some value today, and thank you for tuning in on a Saturday. It makes and I mean it made my day in a way, and a lot of questions and a lot of people watching. uh, um, and please do contact us on chat.goalfi.app or meet.goalfi.app, and you can explore Goalfi.app for Goalfi small cases. The coupon code is on, which is kindly published by the small case team. So again, thank you so much to small case team for giving the opportunity, and thank you all for tuning in. It was a very good catch up to catch up with you. Thank you so much. Let me see if it stopped.